Hello, everybody. Let's try to understand what's happening in the current market scenarios. So, ideally, to be very frank, we have seen the quarter two earnings of Nifty 50, right? The Q2 FY25 earnings, the second quarter of the earnings season in India. And the earnings of the multiple companies and the multiple sectors have not been too strong. Right. So if we talk about the second quarter FY25 Nifty earnings, excluding the oil marketing companies, the earnings has just been 8%. Whereas in the previous year for FY25, the earnings had been 20% odd. Also, if we talk about the further forecasting, also, if we talk about the multiple or the forecasting quarters of the FY25, be it Q3, be it Q4, and also for the early FY26 year as well, the earning forecast has been drastically dragged down from a two-digit number between 15 to 20% down to just 8 to 9%. Commenting upon the valuations in general, we all know that people have been talking about the soaring valuations in India. The valuations have become so high, the companies are not fairly valued, the sectors are not fairly valued. But here we need to understand is a sector might not be fairly valued. A company might not be fairly valued. But here we need to understand and try to pick up those companies through our stock picking abilities, trying to understand fundamental analysis, doing valuations and creating financial models of the companies, understanding the cash flows of the company, the profitability, EBITDA, margins, debt structure, the management kind of commentaries. All these things we need to understand before picking up the right stock into our portfolios. And the previous quarters, be it the FY24 quarter or the last quarter of the FY24, the earnings had been really very strong. And agreed, the valuations have also been really very high. But those valuations were supportive. Why? Because everyone has been talking about the price to earning multiple or the price to book value multiple towards valuation. Theoretically, like whenever we say the price to earning multiple is high or the price to earning multiple is above the 5-year average or 10-year average, sell off that stock. And the vice versa logic plays for a lower price to earning ratio. That is, if the price to earning ratio is very less as compared to the 5-year average or 10-year average, we tend to buy that stock. But here we need to understand in the practical world, it might not always be good to sell an overvalued stock. It might not always be good to always purchase an undervalued stock. Why? If a stock is overvalued and the growth rate in earnings of that company is supporting that, then why not even purchase more of that stock, or maybe for the safer scenario, hold that stock in your portfolio? And the same scenario has been played out in the previous 2 years, 3 years per se. The market became overvalued, or particular themes or stocks became overvalued in those particular sectors. But still, the fund managers or the portfolio managers continuously purchase those stocks because the earnings were supporting the price to earning ratio. Price to earning ratio, and what do I mean the earnings are supporting? By earnings, I mean the EPS, the growth rate in the earnings per share, which is simply the profit after tax of a company divided by the outstanding share. And that becomes a denominator in your price to earning ratio. Price being the numerator and your EPS being the denominator. So the growth rate in EPS or the growth rate in earnings is something that was supporting the price of those companies because multiples tend to get re-rated. If the average multiple for past 5 years is 10 as of now, hypothetically, it might not remain or will not remain 10 in the next 10 years or 20 years. It might get upgraded to 15 or 20 even. So historically, over the past years or quarters, excluding the previous quarters, we have seen the earnings supporting the prices of those shares. And here also we need to understand is since the earnings were supporting the price of those shares, the shares or stocks became overvalued, but still it was logical to purchase those companies. On the other hand, I said it might not always be good to purchase an undervalued stock. There might be some very penny stocks or cheap stocks or like market manipulative stocks. The earnings of those stocks might not be high. The cash flows might not be supporting the stock. The growth projections, management commentary, growth forecast might be almost null and void. And that stock might be trading at a very low multiple as compared to the industry average. Will you purchase that stock? Of course not. So that is the practical implication of the price to earning ratio. But now currently we have seen and why the market started to correct. In October, we saw the market correcting by around 10% odd. The mid cap started to correct. The small caps, they also started to correct. But the fact has been the correction in the small cap and the mid cap has been less as compared to large cap. But why this correction has taken place? Because again, the earnings are not supporting the stock prices now. Till the point of time, the growth rate in earnings or the growth rate in the earnings per share of the company, the denominator of this price to earning ratio was supporting the companies, the stocks rode or the stock rose in the market. But since now the earnings are not supporting the share prices, the stocks have started to correct. People have started to sell off those stocks. So agreed, we saw around like 1.2 billion of the FII selling in October, and we saw some selling in November also. And December has been the only month in the previous months that we have received some positive FII inflow, around like 30,000 crores or like 40,000 crores odd as of this date. But the thing is that the DIIs or the domestic institutional investors have been supporting the market. And here we need to understand the concept of earnings growth, as I just told you in the concept of the price to earning ratio. That's one reason why the market started to correct. Also, the mid cap and the small cap is one such thing that corrected far less as compared to large cap, because historically in the previous many years we have seen that when the large cap corrects by 5%, 10%, the correction in the small cap and the mid cap is far more as compared to the large cap, twice or thrice. After this correction, the large cap has become almost fair valued. The price to earning multiple for a Nifty 50 on a past 10-year basis is around 20.5 to 21. And the current price to earning multiple of Nifty is just the same. It has become fairly valued. And that is why many of the people on multiple online platforms, on news portals, be it CNBC, Z Business, NDTV Profit, have been talking about that large cap is fairly valued. And it's time to rejig your portfolio and shift the allocations from mid cap and small cap. And shifting the allocations from the mid cap and the small cap have been talked about from the previous 2 years. The Nifty 150 index for mid cap or the Nifty 250 index for small cap has become overvalued. Try to like sell off that index or sell those stocks in that index. But here also we need to understand is a ratio that comes into place is the price earning growth ratio. That is the PEG ratio. And why to focus towards the PEG ratio? The rationale why those fund managers who didn't sell off the mid cap and the small cap stocks in their portfolio in the previous years, they lost the alpha run. They lost the alpha for the clients in their portfolio. But those fund managers or the portfolio managers who kept the small cap and the mid cap good quality names in their portfolios, they did fairly well. The reason is they focus more towards the price earning growth ratio or the PEG ratio. So the formula for the PEG ratio is nothing but it's the price to earning in the numerator and the earnings growth of EPS in your denominator. In the price to earning ratio, you just had price in the numerator and the EPS in the denominator. But in the price earning growth ratio, you have the price to earning a whole ratio in the numerator and the earnings growth rate of EPS in your denominator. So that's the growth rate of EPS. That's not the stagnant standalone EPS of the previous quarter or year. It's the growth rate in EPS. The thing is in the price to earning ratio, and why do we use the PEG ratio? PEG ratio is a over betterwise, I would say a better version over the price to earning ratio for multiple scenarios, or an improved version of the price to earning ratio. Because if we talk about the price to earning ratio, the price in the numerator is a leading indicator because the price tends to change on a daily basis. There might be some positive market sentiment, there might be some negative market sentiment, some market news, and that will continuously affect the stock price on daily basis. It changes even in small decimals or small numbers. But EPS in your denominator is historical EPS. The past year reported EPS, the past fiscal year ended EPS that has been taken in the denominator. Because EPS you don't get on daily basis. EPS numbers doesn't fluctuate on daily basis just like price. EPS is only reported on a monthly basis or quarterly basis being derived from PAT and the outstanding shares of the company. You get the annual report, you get the numbers on the moneycontrol.com, and then you tend to calculate the EPS, right? So here what happens, just on the basis of one earnings or one historical year, price to earning might not always give you a true picture because the past performance doesn't always indicate the future performance and the past performance of just the one past year. But if we have the past performance of multiple past years, 5 years, or maybe we can just compare 2 years growth, past 2 years, that gives you a better indication of the future performance and valuation of the company. And that is what the price to earning, the PEG ratio does. It has a price to earning in the numerator and the earnings growth rate of EPS in the denominator. So here we can take over the past 5 years at what average rate the EPS of the company has grown. And that number we take in the denominator. And that shows a much better position or a better commentary or judgment upon the valuation of the companies. And the same happened in case of the small cap and the mid cap. Agreed, the small cap and the mid cap were sheerly overvalued as compared to their 10 years price to earning multiples. But on the basis of the PEG ratio, the price earning growth ratio, the numbers were closer to 1. Now the ratio has crossed 1, like it has become around like 1.1 or something. But till the previous quarter, it was zero point 0.9 or 1. That clearly showed a ratio of less than 1, that the earnings growth of these companies are strong. And since we can hold such stocks or such small cap or the mid caps, good quality in our portfolios. So that was a rationale which the fund managers or the portfolio managers had, who kept the small cap and the mid cap. But those fund managers or the portfolio managers who avoided the mid cap and the small cap, who sold off the mid cap and the small cap just on the basis of the price to earning ratio, they missed the alpha opportunity or the growth opportunity in their client's portfolio. That's one thing. Why the mid cap and the small cap are still rising, though they might face a minor correction or they are facing currently, the majority of the industrial companies or the manufacturing companies are present in the mid cap space. Not even the small cap, but the mid cap space. There is high probability that many of the mid-cap companies become large-cap companies. The probability of the mid-cap companies becoming the large-cap companies is much higher as compared to the probability or the chance of a smaller cap company becoming a mid-cap company. Many of those industrial companies, manufacturing companies, CDMO companies, contract development manufacturing, many of the new age IT companies belong to the mid-cap space. And this sector possesses huge growth for future. All those PLI schemes, all those semiconductor, assembling, manufacturing, all these things that needs to be done, be it for phones, be it for communication services, be it for AI technology, be it in terms of manufacturing, anything which can increase the gross domestic product of the country as well. The I would say the maximum share or the majority share tends to come from the mid cap and not from the large cap. That is one more reason, because all those PLI schemes and the government initiatives and all those targets which the Indian government has to achieve by 2030 or 40, the maximum output can be generated from those mid-cap companies only. And that is why the stocks have been on a rise on a constant spree. And still people are adding good quality names from the mid-cap and the small cap. So not taking the entire index in your portfolio, because investing into a Nifty mid cap 150 or a Nifty small cap 250 might be dangerous, but at least picking up good quality stocks from those indexes which have all those benefits can be like one such thing. Again, going to large cap can be a safer bet, but not the entire portfolio should be in large caps. If you're aiming to invest for just 1 year or 2 years, large cap might be fine. If you are not a risk prone investor or a risk taking investor, the large caps might make you rich, but the prosperous wealth comes from investing into mid cap and small cap or at least a 5 year to 10 year basis. So that is something we need to take care of. So mid cap, small caps is one such theme. We talked about large caps. We talked about the price to earning ratio. We talked about the PEG ratio. Right. Also, a few of the things that we need to understand is the thing is that Fed just reduced the interest rates by some like 25 basis points, and the interest rate has come down to like 4.5% to around like 4.25% there. And the Fed is signaling that they will not that they will reduce the interest rates in the next quarters also, in the next year also, but not by 4 and just by 2. So again, that has also indicated a negative sentiment in the US markets and Indian markets, because ultimately the US markets are linked to Indian markets, or the Indian markets are linked to US markets. But it has also appreciated the dollar. US dollar has been all-time high, around like 108 or something. Because the thing is, when the interest rates in a particular country are high, right, then people tend to purchase the fixed income securities or say for government securities into your country, because that is yielding you much more as compared to the equity, or maybe not yielding more, but it might be at comparison. So why do take some more risk by going towards equity markets, and like why not purchase the fixed income securities? But ideally, at the end of the day, we all know that the equity markets, they tend to deliver you far more better return or inflation adjusted return as compared to investing your money into the fixed income markets, right? So when the Fed told that they shall be just cutting down the rate of interest two times in the next year and not just four times, it increased the value of the USD. Because the higher the value of the interest rates in the economy, or the higher the prevailing interest rates in the economy, the stronger is the US dollar. Ideally, the US dollar should also come down, but on the basis of the expectation, the interest rate, the quantum of the reduction in the interest rates in the next year shall be less as compared to four. पहले चार कम होने थे. In that case, the sentiment was the Fed shall reduce the interest rates four times in next year, and the US dollar shall correct, or the dollar can come down, because the currency would not remain much more stronger when the rate of interest are high, ideally. But now the sentiment is, and even the Fed has clearly stated that they will just reduce the interest rate twice in the second year, right? So it says that it means, or that we can interpret from this thing is that the US dollar will remain stronger for longer. That is one such thing. And when the US market or the US dollar is stronger, the foreign counterpart is stronger, even the FIIs tend to sell off in the Indian markets or emerging markets and go for a safe haven. And that is the USD currency. They tend to purchase their fixed income securities or equities in US and not India. Also, why this has been the reason that why the FIIs has been selling off the Indian markets, because the USD has become very stronger. Now, even the expectation of the Fed rate cut has been reduced from 4 to 2, and the USD has reached all-time high, and the Indian INR has come to all-time low to around 85.4 or something. That's one thing to take into account. So this thing we need to take into consideration. Now that Trump has won the elections, we might be seeing some tariffs around, right? Some 60% increase in tariffs for China, Mexico, and some 30% tariff increase for India, right? The Biosecure Act for pharma again has not been taken ahead. So all those benefits like which the pharma companies had to get in India might not be so much now, right? So again, the Fed has come into place, and we have like Trump winning the election, like he shall be taking the oath also very soon. And again, all these tariffs, the thing is, it might ultimately increase inflation in the US economy also, because a lot of pharma equipments or like manufacturing stuff is again being imported from China. And if the tariffs are raised from the current amount by 60%, again, that might spur inflation in the US economy, because ultimately people will find it difficult to import stuff from China, or even the producers or the manufacturers or the big companies will find it difficult to import those stuff from China. And hence there shall be shortage of such stuff. So the supply of such stuff shall be very less. Because again, the US economy or the big companies in US will face years and years to develop those manufacturing activities or the development activities in their own countries to compete with China. So till the point of time those activities or the production capacity is not being developed, or that kind of science has not come up into US, the thing is the supply would be very less and the demand would be very high. And as a result, the price of those equipments or those raw materials or those goods and services like which were imported from China will rise in US, and that might also spur inflation. And that is the reason when in the previous quarter the Fed reduced the interest rates by some like 25 basis points after the Trump won the elections, the longer end part of the yield curve, the 10-year yield curve, it rose to around like 4.6, 4.7%. The Fed is reducing the interest rates by some 25 odd basis points, but the longer term end or the longer end of the 10-year yield curve is rising by the same quantum. And the reason for that was Trump has won the elections, inflation might come back, and that got priced into the yield curve. So again, yield curve is not always affected by the Fed's decisions of rate cuts. It's also affected by how the economy is running, or how the different sectors or geopolitical tensions or the change in government can also impact, or the change in different macros can also impact the longer term yield curve. So 10-year yield curve rose by the same quantum. Again, that also made the US dollar very strong. And we saw huge outflows in October, November. That's one thing. So I will just share my screen with you. And just before I share my screen, the thing is the mid cap and the small cap, again on the price to earning ratio basis, they still seem to be overvalued. But again, they have corrected. If we talk about the Nifty small cap index, the average 10-year multiple on a price to earning basis is roughly around 23x, is 17x, my bad, right? But currently it's trading at 23x. If we talk about the Nifty 150 mid cap, right, the 10-year price to earning multiple had been 23x and currently is trading at 27x. So again, that is one thing on the price to earning ratio. But here you need to understand the theme for the good quality stocks in your portfolio. Correct. So the thing is, and again, we also talked about the numbers for GDP, right? The growth forecast was around like 6.9 to 7 to like 7.2%, right, for this quarter. But the growth rate in GDP had just been around like 5.4%, right? And the multiple reasons for that. Investment has not risen, consumption has not come back. Because like usually what happens, the average fiscal deficit of India for over the years on a 1 year basis is around 69% or something. In the first half, it has, uh, I would say, the government of India has just entered around 23%, right? The average 1 year ka fiscal deficit for the Indian government has been around 69% every year. But in the first half, it has just incurred around 27 to 29%. So the capex has not taken spree. The capex has not been revived, right? Because we had like just the Indian elections coming into fray. We got the result, we got the change in different governments, coalition, all those things, it came into place. But now the second half or the second or the subsequent quarters are expected to be strong because now the government will come back. The government shall do the government capex or the public capex, and again once that is done, the private capex shall follow, because the trend is the government, it lays down the foundation via the public capex, and once the public capex is on speed, the private capex comes only after that. Never in the history the private capex has come first, then the public capex. So the public capex or the government capex had been very less. And if we talk about the gross domestic product of the country, which talks about the market value of the goods and services being produced in the country, it talks about your investment plus consumptions plus net exports. Investment had been very less. Again, consumption is a story now because in the previous quarters, we saw the urban consumption was doing good, but the rural consumption was not getting revived. But in the previous quarters, recent quarters, we saw that the rural consumption has started to revive, while the two-wheeler sale or the tractor sales and the four-wheeler sales have come down. But the urban consumption has started to come down. Now, both the things need to be regenerated, right? So again, consumption is again something to think about, that when the consumption or when the urban consumption is doing good, the rural consumption is facing issues. But now when the rural consumption has started to come back, the urban consumption is facing issues in terms of consumer non-discretionary or staples. But the consumer discretionary things, right, those high-end luxury products are still getting consumed. So it's good to play that theme instead of being going towards a staple company towards the FMCG sector. Third component, exports. Again, the thing is our imports have risen. Now we like recently saw the data. The current, I would say the current deficit was around like 37 billion, right? Around like 37 crores, right? And that we saw recently, right? Even if I just share my screen with you, and even if you just go in here and just go to the normal, and if you just see that how much has been the fiscal deficit for India in 2020 for the recent number, right? And if we just see, sorry, the current account deficit, because we're talking about exports and imports, current account deficit, right? And if we take it the recent month for November 2024, right? So basically 37.8 billion, right, was a trade deficit. Now, people have been questioning about those import numbers and different stuff, right? The import of gold has not been calculated correctly, and there are some new some kind of nuances in the calculation of gold. But the current account deficit, right? It says the adverse trade deficit print for November 2024 will result in a sharper than expected widening India's current account deficit in the third quarter to 2.8% of GDP. It had come down to 1% of GDP in the previous quarter, and also in one quarter it was positive. We had a current account surplus of 0.7%. Right. So again, these numbers need to be taken into account. Right. And that is one thing. Also, one thing that we need to bother about is, see, the thing is, US, right? It contributes to 5% of the world population and contributes to around 27% of the world GDP. Europe, it contributes around 4.5% to world population and contributes to around 18% of world GDP. China contributes 17% to world population and contributes to 17% of the world GDP. India contributes 17.5% to the world population, but just contributes 3% to world GDP. And how can this be increased? Because this percentage is very less through exports, through merchandise manufacturing, and most importantly, through exports. Because if we talk about the world has a 20 to 80 ratio, that is, it exports 20% of services and 80% of, I would say, the merchandise. Correct. But in India, it is a 60-40 ratio. It's a 60% of your merchandise and 40% is your services, and the vice versa needs to take place. Because in world, 20% is of your services and your 80% is out of your merchandise. In India, 60% merchandise and 40% services, and that needs to get reversed, right? In India, approximately what happens, we have a market of around like 4 lakh crores, like for the mobile manufacturing. It's around like 3 lakh crores in terms of sales. Out of that 3 lakh crores, around like 1.5 lakh crores is for the semiconductor and 1.5 lakh crores for the manufacturing. So semiconductor is something that might not come into India very soon. It might come around like 2028 or something once all the experiments have been done, and that will take time. So the remaining 1.5 crores out of the 3 crores, the companies can focus towards the manufacturing, right? And that will ultimately increase more merchandise and more exports. Because ultimately the issue for the semiconductor will start to resolve in early 2028 or max to max like 2030 or so. Because all those targets need to be fulfilled via the PLI schemes and all those stuff. And around, I say, 450 gigawatt of energy, around like 50 of like, I would say, the gigawatt of energy needs to be produced by 2030. Around like 250 of that shall be catered by your solar, your wind, renewable, and like all those stuff. So again, all those companies are also a very good play. So ideally, the thing is the manufacturing and the export of the merchandise needs to be improved over services. If ultimately the consumption has to be increased and the final number for GDP has to increase, because this is the focus that needs to take place, and ultimately the India's contribution towards the world's GDP should also rise. Because earlier we were just an importing territory. We shifted to assembling around like 2020 or something. And now we need to go towards actual manufacturing as well. And that will take time. So again, all these things need to be focused upon. This will again ultimately increase your GDP, the earning capacity of the people in India, and unemployment being an issue, right? So if I just share my screen as well with you. So again, it's a global market snapshot. Again, this has been taken from Motilal Oswal, right? And if you just see my screen, again, very good numbers, correct? It talks about the November data. So basically, you can see Nifty 50 as of a 1 year basis, it's up by 19.86%. But Nifty next 50 has given you higher returns because it has a much more potential to grow. Because many of the Nifty next 50 companies tend to become a part of Nifty 50, 47.29%. And all the returns for Nifty, I would say the mid cap 150, small cap 250, micro cap 250 has done really well again, because but the micro cap is too risky. And the Nifty 500, all these returns have been given to you on a 1 year basis, 6 months, 3 months, 1 month basis. Now, if we go towards a sector wise exposure, so if we see according to a sector wise exposure, the auto sector has given 33.14% over a 1 year basis. Again, that is something that needs to be looked upon, because the urban demand in terms of four-wheelers have come down. The percentage of SUV sales as compared to the total car sales of the companies have gone up, right? The premium cars are being sold much more as compared to the smaller cars or compact cars. And also the demand for two-wheelers or tractor sales have come to a revamp now, because the rural consumption has started to revive. So again, auto sector needs to be given some weightage and some analysis to work upon. Again, banking sector being high, because everyone had been complaining about the banking sector and the IT sector, but again, these sectors have been high. The one reason that can be attributed for the banking space is again is trading at a lower multiple on the price to book value basis, right? I won't go to stocks, but again, it's an undervalued theme. And also the problem for the deposit and the credit creation has been resolved now, because the banks were instructed by the RBI in the previous quarters to increase more deposits, to garner more deposits and focus less towards the credit creation. But now the issue has been resolved, and all those numbers and all those the rate at which they were like giving out loans or the credit creation and the deposit rate, they've almost converged. And in the previous quarter, we recently saw the deposit growth had been a bit higher as compared to the credit growth. They have been trading around like 11.5%, 11.4% around. But again, this issue has been resolved. And since the RBI has not yet reduced the interest rate, they're still waiting for the interest rates to get reduced, right? Because they still believe inflation is a concern. We recently had a 5.78% number for November. Food inflation being as high as 9% like year on year. Again, that's an issue. Correct. So again, they're waiting for that. And again, maybe that is also providing a respite for banks, because if the interest rates come down, they'll have to reduce the interest rates in the credit creation part first, because the rates that they're charging upon the loan, the reduction in the interest rates get priced in the loans first as compared to deposits. And once the pricing has been done in terms of loans given, the interest rate that the banks can command on the loans given to you will be less, but still the interest rates on deposits will be high. Though the rate on deposits shall also come down, but that comes with a lag. And that might hurt the NIMs for bank or the net interest margins, right? Again, consumer durables have been doing good. Energy is a very good theme. Clean energy, wind energy, solar energy, all those sectors have been doing really good. FMCG again is something to look upon because consumption is still an issue. Healthcare, all those CDMO players have been doing really good because now India is doing all those sourcing in API, all those things are being built in-house, CDMO, all these kinds of drugs are being developed and getting approved by the US FDI too. IT sector, people have been talking trash about IT, overvalued, but again, the mid cap and the large cap IT sector have been doing really good. Every fund manager, every person in the market has been complaining about the consumption is low, the interest rate is high, the demand for IT services is not so good. But here we need to understand when the banking sector is doing really good, the IT sector also does really good. Historically, they have exhibited a linear relationship because many of the services the banking takes from those IT companies only, large cap IT companies, mid cap IT companies. So basically, the debate between like whether to choose for banks or ITs, if one sector is doing really good, the other shall do absolutely good. So not to worry about that. And like whether to choose between the large cap and mid cap, again, I don't understand that debate because again, they are trying to export their services outside and they will achieve a very good margin. There shouldn't be a debate upon that which company will do well in terms of large cap and mid cap. People can debate upon the valuations because mid caps are being at a higher valuation as compared to large cap, and that is where people have tried to build up more positions in large cap. But again, the mid cap have given more returns as compared to large cap. So the thesis should be take quality large caps in terms of ITs, which seem fairly valued. But in terms of mid caps, all those stocks whose earnings growth in terms of EPS are more, be it overvalued also. Try in the market and go and purchase those stocks. That's it. Again, metal sector, China stimulus, all these things have been like favoring the metal sector. Again, reality and defense is again a cycle. Defense through PLI schemes and different government support. Because again, defense as a percentage, defense exports as a percentage of GDP need to be increased to around like 25% to 30% by 2030. So with it, the defense sector becomes overvalued. Again, it might suffer a kind of a correction, but the stocks have to come back in the market. And again, a reality sector is basically a 10-year cycle. We are at a mid stage, I believe. And again, this sector can also do really well. That is one thing that we can focus upon. Now, focusing towards these strategies, again, equity strategy or a factor strategy, momentum has performed really well, 41%, enhanced value 39%, quality 31%, and low volatility around 19%. So these are those factor ETFs or beta strategies or smart beta strategies as we tend to talk about in the market popularly. And these have been the yields in terms of Indian markets for 5-year, 10-year liquid or the short duration debt. Again, it's a publicly available document. It's not something I'm putting out in the market for the first time. Now we have seen these numbers again. S&P has been performing really good, 32.06%, but after the Fed cut, it corrected by 3% or so. Right? Nasdaq, Dow Jones, again in the emerging markets, China, Taiwan have been doing really well. Taiwan has been doing really well upon the semiconductor side. China was doing well. It started to correct a bit on account of the stimulus was not enough. And people believed, and many analysts also believed, that the stimulus that came into the market was not to revive the economy, but just to revive the stock markets. Again, that is something a concern. Korea, Brazil not performing well. South Africa market, which has rebounded really well, which really people are talking about. And the reason for that is something we should find it out in the markets. That why South African markets and the emerging markets are doing really well. surpassing even the Chinese markets, Korean markets, and Brazilian markets. So that is something to look upon. Unheard market might be a value pick too for those who invest globally. Japan, United Kingdom, France is again negative, Germany, and this is all the commodity prices, the forex that we have seen. Again, like nothing to comment upon Bitcoin or Ethereum because again that doesn't possess any value. But if you are a cryptocurrency lover, it's good to go for the world as well. Then all these numbers in terms of India, because we have been talking about 4% rate of unemployment in US and all those things, but we should also talk about India as well. CPI inflation 6.2%. This is the number as of 31st of October, but as of November, the number has been around like 5.78%. Again, that has increased. Repo rate, all these things. PMI numbers that shows the confidence of the purchasers, managers to purchase those stocks or not, to purchase the company's raw materials to run business operations around 59.50, much higher than US. The stand at around like 55.3. Again, the GST collections have been good. And one more way to gauge that whether the economy will do good, or like whether the Indian economy will do good or not, or how are the businesses performing, is via the GST collections. If the GST collections are rising, it ultimately means the businesses are doing well, the sales are good, the demand is more, and the consumption might get revived in the near future. And again, that stimulates the economy. So again, GST collection is like one such number. PMI we talk about, and if we talk, and same for the US tax receipts. If more people are paying tax, it means, okay, it's good to go for the economy. Unemployment in US is 4.1%. In India, it is 8.1%. No one talks about the unemployment rate in India. We just have a number getting published. But in US, everyone has been talking about the unemployment rate. And that is something we need to focus upon because India ka rate is almost twice than US and we need to work upon that. So agreed, US is a developed market. India is an emerging market, still doing really well. But this rate differential has to come down in terms of unemployment as well. So that is something to focus upon, right? So ideally, that was basically we tried to talk about different sectors. We tried to talk about the global economies. And one more thing we can also talk about is that India, if I'm not wrong, it's facing a situation of stagflation. And what is stagflation? It has two components. One is stagnancy and one is inflation. Stagflation is something when there is high inflation and no growth, low growth. Here we can see inflation is rising. The RBI has been unable to control inflation, though it was in the previous quarters when it reached around 4.5, 4.7%. But again, it rose to like 5.7, 6.2%. So inflation has been high and the growth has been low. Growth in terms of GDP, the GDP projection of 7.2% has come down to 5.4%. So there's still some economists who believe that the consumption shall revive, the investment will revive, and we might have this number of around 6.5, 6.6% in the subsequent quarters. But as of now, the number has come down to 5.4% GDP and higher inflation number. So higher inflation and low growth, it's a consequence of stagflation. So again, that is something we need to understand. Also, we need to understand one more thing is US contributes to around like 70%. So like 27% of GDP and 70% of the market share in terms of stock market, right? US is using 50% of AI in its services, like Europe around 30%, China being 15%. The productivity rate of US is also very high, around like 15 to 20%, and the Europe and China follow the same. The research and development in US has been around like 2.1% of GDP. China is coming closer to that. So again, China versus US is again a kind of a different debate to look upon, but all these parameters need to be taken into account. So my current thesis is people might talk about the different challenges in 2025 that we might get, or some Fed challenges, some RBI challenges, some stock challenges, or the overvaluation challenges. But at this point of time, the thing is, if you're a long-term investor into the equity market, now here I'm talking about from an equity approach, it's good to go for small cap, mid cap, and large cap stocks, everything. You can have a portfolio or you can have a large cap composition as a higher weightage if your time duration or your time horizon to invest into equity is less. But if your investment time horizon into equity is high, or you expect to invest into equities for 5 years, 10 years, 15 years down the line, taking approach towards the mid cap and the small cap is one such thing. So good quality mid cap and small cap that give you growth, being supported by the PLI schemes, good management, good cash flows, good profitability, good earning growth. Because agreed, in the previous quarters we had the earning growth of the mid cap and small cap around 35%. It has come down to 8 to 9% now. But still, there are some companies who are still growing at a very high rate And that can become a part of your portfolio to give you the extra alpha or the extra investor alpha or the management alpha, as like whatsoever you may call it. So that is something that can be a good composition or a good ingredient in your portfolio. So that is something you can go for. Apart from that, a multi-asset approach is always there. Some allocation towards a fixed income and some allocation towards an equity, a 60-40 portfolio being very popular in the US terminology can be one such thing. Whereas HNIs have started to take exposure to alternatives, towards high yield, towards floating rate credit, towards private debt, infrastructure, real estate is one such thing the poor people can look upon. And again, this is the approach which a person can look forward to. So that was something very basic about the current market scenario we tried to talk about different economies, macro indicators, inflation, interest rates. Not deep dive into stocks, but about sectors, about macros, how the US, India market can perform, and all these things we try to discuss upon. So that is something for today. And thank you so much. Feel free to get back to me for any questions or concerns. Thank you so much.